Welcome back to the Investing Markets and Money podcast. And today we're talking about Indian equity markets. And on the podcast today is James Thom, who's a senior investment director at Aberdeen Asset Management and also responsible for the new India Investment Trust. And we're going to have a chat about the Indian market, investment prospects, and what's going on there. Welcome to the podcast, James.
Thanks very much, Stuart. Great to be with you.
Can you give us a quick overview of the new India Investment Trust, what it sets out to do for its shareholders?
Yeah, so as the name suggests, it's a UK or London-listed investment trust investing in the Indian equity market, and it's managed by Aberdeen, myself and my colleague Rita, with support from the broader Asian equities team at Aberdeen, based out of Singapore, which is where I'm based. And the objective of the trust is long-term capital appreciation by investing in the Indian market. And really, we do that by selecting a portfolio of what we consider to be the highest quality stocks across the Indian market at reasonable valuations, to the extent that reasonable valuations is feasible in India. It is a market that trades more expensive than most other markets, but we can go into the reasons why that is. So essentially, it's an actively managed, conviction-driven fund, which gives you access to the best quality names in India.
And I've seen a number of different Indian funds and investment trusts, and even ETFs have done well in 2024. Obviously, we're in 2025 now. World looks quite different. Why should investors not be ignoring India this year?
Yeah, India's had a great run. It's been pretty much 3 years now of bull market type conditions, and that has now corrected a bit. In my view, that is a good thing. I think we needed a bit of a reset, and we've got it. And to my comment earlier about valuations in India, I mean, they had got pretty full and were looking a bit frothy in some places. And now we've seen a reset, and valuations are now down to much more sort of reasonable levels, kind of broadly in line with their historical averages. So that's good. And certainly for stock pickers like myself, that spells opportunity. I think also, you commented that the world is a very different place in 2025, and that's true. And now India isn't immune from some of the turbulence that we're seeing across kind of global markets. But I would say it is less impacted and less vulnerable than many others. And certainly when you think about emerging markets more broadly, India is not an economy that's particularly trade driven. It's primarily a domestic story. So whilst we may see tariffs get levied on India as elsewhere, the likelihood is that will have a relatively lesser effect on the domestic, on the overall GDP growth opportunity and potential in the country. So I think it's almost, well, I would say it's less exposed, less vulnerable, a little bit more of a safe haven in the context of emerging markets.
And the economic growth's been very impressive for India last year. It's one of the stars in the emerging markets arena now. Do you think that that's something that's sustainable going forwards?
So the growth has been impressive. I think it kind of peaked in 2023, where it grew more than 8% that year. It's come off a bit since then. The estimates for 2024 is more like sort of 6 or 6.2% type growth. Still pretty good, and makes it one of the fastest growing large economies anywhere in the world. It's slowed down a bit in the last couple of quarters, and there are good reasons for that, but I think they are largely temporary and cyclical in nature. I think the long-term structural growth drivers that kind of underpin economic growth in India are still very much intact. The obvious things. This is a population of 1.4 billion people, and that population is getting richer and spending more, and that's driving an emerging middle class. It's driving spending on all sorts of products, services, You're seeing continued urbanization, continued digitalization. So all of these things that, those long-term structural trends are intact. So I think there's no reason why India can't sustain a kind of 6.5–7% real GDP growth rate for many years to come.
Yeah, and as you say, it compares very well with China. Do you think that some of that decline is just because it's becoming more of a developed, more mature economy, and investors can't expect that kind of huge growth trajectory for a more mature economy of this size?
Actually, that's not my perspective. I think India is still very early in its sort of stage of development, and is still quite a long way from being a mature economy. In many respects, it's 10 or more years behind China. There's one data point, which is the kind of GDP per capita data point. India's at $2,500, maybe $3,000 per capita at the moment, which is where China was 10 years ago. So I'm not saying it's going to follow the same trajectory necessarily as China, but it's still got a very long runway that can sustain that 6.5–7% type growth.
And how important is the rural economy in India to that overall growth story? And how do investors like yourselves get exposure to that?
So it is important, without a doubt. That there's economists kind of debate, as they always do amongst themselves, as to what exactly is the rural economy. It's a slightly artificial construct. The definition of rural is a bit abstract and a bit you can cut it and slice it many different ways. So you see, agriculture and farming is a big part of the Indian kind of economic activity. You see stats that say maybe it employs kind of as much as half the population, but contribution to GDP isn't so high, maybe 20%. But then you see other stats that say the rural economy is home to 65% of India's population and contributes as much as 50% of GDP. So there's all sorts of conflicting data. But anyway, it's a big material part of the Indian economic story. And actually, it's one that's been misfiring in recent years. So India has managed to deliver that kind of 7–8% type GDP growth despite this huge part of the economy being very subdued and really hasn't recovered since the pandemic. So you see it in, and to your question around how do you get exposure to it, we have exposure to it through the New India portfolio, through, for example, our consumer staples stocks. They have large distribution networks into rural India, selling in the small mom and pop stores. And they've been seeing pretty much flat volume growth for a prolonged period of time now, when they're used to sort of seeing 8–9–10% type volume growth every year. So it's been impacted negatively by inflation, which has been a bit high, but is now under control. Because agriculture is such an important part of the economy, the monsoon rains are vitally important to the India story, and that we've had some poor monsoons, but again this year we've got better rains. So there are signs that this is perhaps now finally beginning to turn, and the consumer staples companies that I mentioned are now talking more positively about their outlook. And so when it comes, I think this is going to be a really nice additional driver for growth for India. And it's not just consumer stocks. We have financial companies that are serving the sort of underserved, underbanked kind of rural market. We've got other companies that are providing fertilizer, crop protection in the sort of agricultural space. So there are many different ways of playing.
And I write a sort of weekly global IPO overview for our readers. And one of the things I've really noticed is just how hot the Indian IPO sector has been, just how many companies have been coming to the market, and also how heavily oversubscribed they are, both on the institutional and the retail side. What's contributing to that? Why is there so much activity there?
There are a number of factors, I think. Partly it just reflects the health of the market, and as I say, we've had nearly 3 years of bull market kind of conditions, and that naturally attracts IPOs. to try and capture the attractive valuations. And quite a few of the companies that are listing are kind of new economy, internet type businesses that have been backed by very significant private equity and venture capital investment over the last several years. And those investors are now looking for exits and bringing these companies to the market. We saw a sort of big spike in IPOs back in 2021, then it went quiet as the sort of global interest rate regime changed and rates began to rise, and that wasn't so conducive for high growth but often sort of pre-profit type companies that are the characteristics of some of these kind of new economy stocks. But I think now with interest rates sort of normalizing a bit or stabilizing at least, these companies are having another look. The retail investor that you mentioned, we've seen a quite remarkable surge in retail investor participation in the Indian market generally, not just in IPOs, but the number of new accounts and brokerages that are setting up to serve the retail market has ballooned. So that's inviting new flows into the market. So I think it's all of these factors combined, and the fact that India has historically been quite a traditional stock market, banks and telco companies and old economy sort of stocks, and hasn't had, in contrast to China or other markets, all of these new economy type companies, and now finally they're beginning to come through, which I think ultimately is good for the market.
From your perspective, which sectors look the best positioned right now in the Indian market?
So if you look at the new India portfolio, you'll see that we've got a pretty sizable exposure to the financial sector. Now that is quite diversified, so it's about a quarter of the fund in financials, but we've got a number of 3 banks within that. In fact, the 2 largest holdings in the portfolio currently are 2 banks. These are private sector banks, as distinct from the state-owned banks that dominate the Indian banking sector. And these banks have been very well run, really good management teams, very solid in terms of their kind of credit underwriting and management of asset quality, and have gradually and steadily every year been kind of eating away at the market share of these state-owned banks. And we think that will continue. And the valuations in an Indian context are still pretty reasonable. So we like the banks. We've got a couple of what are known as non-bank financial companies, or NBFCs, in the portfolio as well within the financial sector. These are companies that really, to your or the earlier points on the rural economy, these are the companies that serve the underbanked part of the market, and again have done so very well. We've got insurance and capital market plays there. So financials is a big part of the fund. We've got quite a big exposure to the healthcare sector, again quite diversified. So India's well known for its pharmaceuticals industry, which it's sort of been successful on the global scale. But we've got a domestic pharma company, we've got a devices company, we've got a diagnostics company, a hospitals company. So pretty broad exposure there, and all delivering really quite attractive double-digit growth consistently over the years. And then I would say we've talked about consumer. We've got a fair exposure there. And particularly sort of positioning around what we call kind of aspirational consumption. So to my point around people getting wealthier, that middle class emerging, that's driving this sort of aspirational consumption and upgrading and premiumization of spending. And so that's been a pretty dominant theme in the portfolio and continues to be. And then finally, we've got a fairly large exposure to the IT services sector, which has, again, been one of India's great success stories. Created these super high quality companies that compete with the likes of Accenture and IBM and others, Capgemini, and they have been not doing that well in the last several quarters, but we think a little bit like that sort of rural economy story and some of the consumer staples companies, we think they're at a bit of a turning point now. The US is a big market for them, and they're seeing IT spending kind of coming back from their corporate clients in the US post Trump's re-election, and the sort of animal spirits coming back a bit, and so we think growth should pick up from here.
And from an India specific perspective, how do you go about selecting stocks for this particular trust?
So as I said, we're a long-term quality manager, and that's our philosophy. So we are, in very simple terms, just trying to find the best quality stocks in India and not overpay for them. Having said that, quality means different things to different people. And for us, when you think about India, we're looking at and screening for all the things you'd expect a quality investor to screen for. So companies with strong market position, nice sustainable source of competitive advantage. That tends to mean that these companies have superior financial track records in terms of top line and bottom line growth. They tend to have higher margins, better return metrics than their peers. So we're looking at all of that, but we also put a big emphasis on kind of balance sheet strength. So we think quite a lot about downside protection. And India is a fantastic growth story, but it's still a young emerging market and economy, and so it can be volatile. And so you want companies that can weather that. And one way in which you ensure that is that they're not going to get into difficulty on their balance sheet, that they have good cash generation. And I think the other thing that we spend quite a lot of time thinking about and is sort of specific to India or emerging markets generally, in that you tend to find that companies in India have one single large shareholder. So it's quite different to the UK and Western stock markets, where it's a very fragmented shareholding. In India, you tend to have one majority shareholder. Now, that might be the government, it might be a family, it might be an individual entrepreneur. But it's hugely important to just understand who that shareholder is, how they have treated minority shareholders historically, and ultimately just ask the question as to whether you can trust that single dominant shareholder with your capital. And if the answer is no, then it doesn't matter how great a business it is, we would walk away.
No, that sounds very, very sensible to me. And lastly, I wanted to ask you about, it's more of a generic question around asset management, but it's this balance between the star fund manager versus the more team-based approach. And I know at Aberdeen, you guys lean more into the team-based approach. What would you say are the sort of specific advantages that come with that, with having multiple people, like for example on this fund, looking after a portfolio like India, rather than a kind of single guy making all the decisions?
Yes, it's always an interesting debate, and the two models can both work very well. As you say, at Aberdeen, we've always preferred the team-based approach, and for the simple reason that we think it leads to better and more sustainable investment outcomes. If you are sharing and pooling your thinking and incorporating multiple perspectives on stocks, companies, the market, and that in that way sort of overcoming any individual biases or sort of behavioral patterns or biases that any one person might have. So that's been, through my career, I come originally from a private equity background, and in that industry, almost all investment decisions are made through committee, through an investment committee, and that's the standard for that industry. And it's sort of this slight oddity, I think, in some ways, that public equities and public equity fund managers have this sort of star manager kind of mentality and approach. It can work very well, but I think the sort of group consensus-driven decision making is often the best model. A more sustainable model.
Thank you very much for that perspective there, James. And also thank you for coming on the podcast this morning and talking about the Indian economy. I'm a big fan of it myself, and I think it's certainly something a lot of investors should be paying more attention to. So thank you very much.
Yeah, thank you. It's been a pleasure.
You've been listening to the Armchair Trader podcast. Make sure you visit our website, www.thearmchairtrader.com, for your daily dose of financial markets news, and sign up to our free newsletter there.